Welcome to part 2 of this course. The very first topic that we'll cover in this part is about technical indicators. So, this part of the course deals with interpreting market action and using our interpretation to our advantage as an edge over other traders. So, a large part of the market looks at technical indicators. So, if you're an existing trader, you already are very familiar with technical indicators. And even if you're a new trader, we will cover some of the leading technical indicators shortly in the coming few videos. So the key question really is that the technical indicators, which a vast part of the market looks at to make trading decisions, do they really work? So the way this is organized here is we have taken a leading stock from 7 different sectors here. So these are the 7 different sectors, and these are the leading stocks in each of those sectors. And here we have compared the performance of 5 leading technical indicators on each of these 7 stocks. So the first two are Bollinger Band and RSI, which is the relative strength index. They are mean reverting indicators. And what is mean reverting? If you're not familiar, we will cover shortly. But for now, just stay with me. The key point really is that we want to see the performance of these indicators. So these two are mean reverting indicators, and we are taking 5-day accuracy because whenever any asset is mean reverting, we give it some time to stabilize after reaching a high or after reaching a low before it starts reversing the price. So we are being conservative and we are taking the accuracy over the next 5 days after it reaches a particular threshold. But the next three, that is moving average, MACD, and stochastic, they are momentum indicators. So momentum indicator indicates that a stock is in momentum in a given direction, and hence it should respond to the signal soon enough. Hence, here for moving average, MACD, and stochastic, we are taking a 2-day accuracy. Whereas for mean reverting indicators like Bollinger Band and RSI, we are taking a 5-day accuracy, assuming some time for price consolidation before it starts reversing. So this table actually depicts what is the accuracy, and here we have taken a threshold of 60% accuracy at least to set up a high conviction trade, because 50% is even Steven. It can go up, it can go down, we can be right, we can be wrong, but anything above 60% is what we are considering as high conviction trades, or relatively high conviction trades. So now we are comparing that each of these indicators on each of the sides. So we are taking a bullish side and we are taking a bearish side indicator accuracy scores for each of these 5 indicators for each of these 7 stocks. So, and we can see that in each of the leg, how well a given technical indicator performs for a given stock or a given underlying. So here we see at a composite level across all of these indicators, up and down, these 5 different indicators for these 7 different stocks, the composite high conviction accuracy is only 32.8%. And if we take it for the sectors, 2 major sector indices, which is Nifty and Bank Nifty, and here we are only considering 2 liquid indices from a viewpoint of option trading, because other indices they are not very liquid. So Nifty and Bank Nifty, the same composite score of accuracy of these indicators is only 45%. And this is not surprising, because if one were to think about it intuitively, one cannot profit from an information which is available to everyone. So anybody who's been doing trading for long enough, they all know that everybody just looks at technical charts. So if people are looking at technical charts and making a decision, right, nobody has an edge. And trading is a zero sum game. What one wins, somebody else loses. And profitable trading requires an edge, essentially information advantage over other traders, as market overall is a zero sum game. So if a buyer is looking at the same chart as a seller and assuming they both are equally skilled, then they will look at the same information. And if that information is indicating an advantage for one over the other will not enter the trade. And this will reduce the profitability of that information. And this is very prominently reflected in this chart. So this chart shows the open interest position of various market participants on a day-by-day basis and the movement of Nifty. So the blue line here shows the combined open interest position, the combined net open interest position of FIIs and professional traders, whereas this dim red line here shows the open interest position of the retail traders. So retail traders are the ones who have less sophistication compared to the institutional traders and professional traders, and see what happens. The green here, the green line here shows how the Nifty has been moving. So you will notice that the open interest position, or the position that FIIs and professional traders take in the market, is extremely aligned with the movement of Nifty. Whereas retail traders, on the other hand, who lack sophistication, seem to be going wrong on a continuous basis. So you see, whatever is the position of Nifty, Nifty is going up and the retail traders are taking a short position in the market. And when the Nifty is falling, that is when they are taking a long position or they're being bullish in the market. So their entire position or their entire approach to the market seems to be completely at loggerheads with the way the market is moving. And it's also opposite to what people with informational advantage are doing. So while lots and lots of traders, they refer to technical charts as their bible for making trading decisions, but we saw clear empirical evidence here that technical charts do not give you an advantage. In fact, it can be a sure shot recipe that if you're relying only on technical charts to be trading, the odds are going to be against you and somebody else will have a trading advantage over you. So, in the next video, we will talk about how computational finance can actually come to the rescue, and computational finance coupled with technical and quantitative indicators can provide an informational advantage in your trading decisions.